You swipe. You buy. You move on. But while you're out grabbing coffee or shopping online, there's a machine working behind the scenes, and it's pulling in billions every year. So how do credit card companies really make money? Credit card was first founded in 1950 by Frank McNamara. Today, we're diving deep into the world of credit cards, following a guy named Simpson who thought credit was free money and ended up in a trap millions fall into. Let's go. Meet Simpson. 24 years old, fresh out of college. Landed his first job at a tech company. Salary, $48,000 a year. Simpson's never had a credit card before, until now. He just got a shiny envelope in the mail. Congratulations, you've been approved for a $5,000 credit limit. No annual fee, 2% cashback, and a low introductory interest rate of 0% for 6 months. Sounds great, right? Free money, or at least that's what Simpson thinks. He's excited to use this credit card, especially with no interest for the first 6 months. He figures, I'll pay it off when the time comes. But here's the thing. Credit card companies know exactly how to get people like Simpson hooked. It's not just about that 0% interest. The real money starts rolling in as soon as Simpson misses a payment or carries a balance. Let's see how. How credit card companies makes money. 1. Interest and fees. At first glance, credit card companies make money primarily from two things: interest and fees. When Simpson doesn't pay his credit card balance in full, the credit card company charges him interest. This interest is typically quite high, often reaching upwards of 20% annually. If Simpson only pays the minimum, he ends up paying a lot more in the long run. 2. Annual fees. Credit card companies also charge annual fees. Simpson's card has a $100 annual fee. These fees are charged regardless of whether Simpson carries a balance or not. For premium cards with rewards, like travel perks, the annual fee can go much higher. Even if Simpson doesn't use the card much, the company still makes money. 3. Transaction fees. Every time Simpson uses his credit card, the merchant has to pay a fee to the credit card company. This is called the transaction fee. Typically, it's around 1 to 3% of the total sale. Simpson might not realize it, but when he buys groceries or shops online, the store is paying a cut of his purchase to the credit card company. And guess what? Credit card companies make millions off these tiny transaction fees, especially since people use cards for nearly every purchase. 4. Late payment fees. Simpson made a mistake and missed his credit card payment. Now, he has to pay a late fee. These fees are another significant revenue stream for credit card companies. If Simpson pays late just once, he could be hit with a fee ranging from $25 to $40. For credit card companies, late fees are a win. They're charged frequently and add up quickly, especially for people who struggle to make payments on time. 5. Cash advance fees. Sometimes Simpson needs cash, so he takes a cash advance from his credit card. Credit card companies charge hefty fees for cash advances, often around 5% of the total amount withdrawn. Not to mention, interest on cash advances kicks in immediately, with no grace period. These fees are even higher than regular purchases, making cash advances a very lucrative source of revenue for credit card companies. Now credit card companies also offer rewards programs. Simpson's card offers points for every dollar he spends. These rewards sound great, but here's the catch. To fund these rewards, credit card companies raise interest rates and annual fees. Essentially, they make money from the people who carry balances while rewarding those who pay off their credit cards in full. The rewards are like a carrot on a stick, great for the consumer who's responsible, but a tool to keep others spending. Credit card companies also partner with banks, airlines, and retailers. These partnerships allow them to share in the revenue generated from their cardholders. For example, Simpson might have a credit card from a bank, but it's also linked to an airline's frequent flyer program. When Simpson spends money on the card, the airline shares in the profits, and the credit card company earns from this partnership. Credit card companies make money from more than just fees and transactions. They also know that not everyone will pay back their debt. When someone defaults on their credit card payment, the company can write off the loss, but also makes money by adjusting interest rates for people who do pay on time, spreading the risk across the customer base. By carefully managing risk and using collection agencies, credit card companies ensure they remain profitable even when some customers fail to pay. So, how do credit card companies really make money? From high interest rates, fees, transaction charges, and strategic partnerships, the business model is built to profit from every angle. The more you use your credit card, the more they make. The system works because people like Simpson use credit cards for convenience, rewards, and purchases, often without realizing just how much it costs them in the long run. Next time you swipe that card, remember that credit card companies are making money off of your spending habits. But with awareness, you can avoid the traps and make smarter financial decisions. Thanks for watching. Don't forget to like, comment, and subscribe for more financial tips and insights.